It's a Monday morning. You open your investment app. You've been doing this every day for 3 weeks, sometimes twice a day, even though you told yourself you wouldn't, even though checking daily changes nothing. But you check anyway. Your long-term portfolio, the one you built carefully, the index funds, the diversified positions, the retirement account you've been contributing to consistently for 3 years, is down again. Not catastrophically, not wipeout territory. Your $45,000 portfolio is now sitting at $38,700, a 14% drop over 3 weeks. A correction, technically, the kind that happens in every market cycle. The kind every credible investing guide, every wealth-building framework, every long-term financial independence strategy describes as completely normal, expected even. And yet, your chest is tight. There's this low-grade hum of anxiety that's been running since this started. And this morning, for the first time, a very specific thought surfaces clearly. What if I just sold everything? Just for now, just until things stabilize. You sit with that thought longer than you expected to, and then you do it. Everything converts to cash. The number stops moving. The anxiety quiets almost immediately. For a brief moment, you feel like you did something intelligent, like you took control of a situation that was starting to feel uncontrollable. 6 weeks later, the market has fully recovered. Your $45,000, had you stayed invested, would be sitting at $47,200, a full recovery plus growth. Instead, it's in a savings account, earning 0.4% interest. And you're trying to identify the right moment to get back in. That moment never quite arrives. Here's what makes this worth examining, carefully. You're not a reckless person. You didn't stumble into the market uninformed. You researched. You understood the principles of passive investing. You chose low-cost index funds, the exact foundation that serious long-term wealth-building strategies consistently point toward. You had a written plan. You believed in it when you wrote it, and you still sold at the worst possible moment. So what happened in the space between the rational plan and that Monday morning decision? Because it wasn't new information. A 14% correction wasn't a signal that something had fundamentally broken. Corrections like this are a normal feature of market history. You knew that. It wasn't a knowledge gap that drove the decision. It was something else, something faster than knowledge, something that moved underneath the plan and arrived at the decision before the rational mind had even finished assembling its argument. And here's what makes this genuinely interesting and genuinely worth understanding. This isn't rare. This isn't a personal failure. Studies on retail investor behavior show that everyday investors, people managing their own portfolios, contributing to their own retirement accounts, building toward their own financial independence, consistently make their worst investment decisions during exactly these moments. Not during stable periods when they have the bandwidth to think clearly, but during the moments when the number is moving in the wrong direction and the anxiety is loudest. The knowledge is there, the plan is there, and something overrides both of them. So what is that something? Let's pull the thread carefully, because the answer is more specific than most people realize. Think about what was actually happening in that scenario, not financially, psychologically. The portfolio dropping from $45,000 to $38,700 meant something was being lost. $6,300, real money. And the brain was registering that loss in real time, every morning, every app check, every notification. Now think about the period before the correction, when the portfolio was performing, when that $45,000 had grown to, say, $47,000 over the previous quarter. How did that feel? Satisfying, validating, a quiet sense that the strategy was working. But was it as consuming as the feeling during the drop? Almost certainly not. And that asymmetry, the fact that the downside felt so much more intense, so much more urgent, so much more demanding of action than the equivalent upside, is the thread worth pulling. Because it isn't random. It isn't personality. It isn't a reflection of how serious you are about your finances or how emotionally mature you are as an investor. It's a measurable, documented, remarkably consistent feature of how the human brain processes financial outcomes. And once you understand it clearly, a great deal of otherwise inexplicable investor behavior starts to make a very different kind of sense. Behavioral economists call it loss aversion. And the research on this is remarkably consistent. Different markets, different income levels, different levels of investor experience, same pattern, every time. Losing a sum of money feels roughly twice as painful as gaining the equivalent amount feels good. Twice. Which means your brain isn't running a balanced risk calculation when it evaluates your portfolio. It's running one weighted toward avoiding loss, not toward maximizing long-term returns, not toward optimizing compound growth, toward avoiding the immediate, visceral experience of loss. Those are very different objectives. And over a retirement timeline, they lead to profoundly different outcomes. I remember the first time I really sat with this finding. Not just read it, actually sat with it. And I started connecting it to every investing decision I'd ever made that I couldn't fully rationalize afterward. Every time I checked my portfolio more than I needed to. Every time I felt that pull toward cash, toward safety, toward just wanting the number to stop moving. It wasn't weakness. It wasn't a lack of financial discipline. It was arithmetic. Painful, asymmetric arithmetic my brain was running whether I wanted it to or not. Research took this further into actual investment decision-making. When participants were shown two options with mathematically identical expected returns, one framed as a potential gain and one framed as avoiding a potential loss, they consistently chose the loss avoidance option, even when the gain option was objectively better, even when the math was explained to them explicitly. The framing alone changed the decision. Which means loss aversion isn't only about the experience of losing. It's about how any financial choice gets categorized as something to pursue or something to protect against. And the protect against category carries almost double the psychological weight of the alternative. Loss aversion doesn't produce only one kind of investment mistake. It produces several. And they're worth naming, specifically, because they look different on the surface but share the same psychological root. Pattern 1. The panic sell. You already know this one. Markets drop, the rational case for staying invested is clear, well documented, and historically supported. Long-term passive investing in broad index funds has rewarded patient investors through every major correction in modern market history. And yet, studies on retail investor behavior consistently find that individual investors tend to sell at or near market bottoms. The precise moment when, mathematically, staying invested, or even increasing contributions, makes the strongest case. Because the psychological pain of watching the loss accumulate becomes unbearable before the rational argument for patience has time to hold. Research on long-term market returns found something particularly striking. Missing just the 10 best trading days in a decade, days that often occur immediately after the sharpest drops, can cut long-term portfolio returns nearly in half. Investors who panic sell don't just lock in a loss. They often miss the recovery entirely. And the compounding effect of that missed recovery on a retirement account or a long-term wealth-building portfolio is not a small number. Pattern 2, the disposition effect. This one runs in the opposite direction, and it's equally expensive. Someone buys a position at $40 per share. The stock declines to $22. Every rational signal, fundamental analysis, market trajectory, opportunity cost, suggests cutting the loss, reallocating the capital, and moving forward. But they hold, because selling makes the loss permanent. While the position is still open, the loss is unrealized, still technically reversible. The moment they sell, it crystallizes into fact, an entry in the permanent record of decisions made. And accepting that fact means accepting they were wrong, so they wait for the stock to return to $40. Not because the fundamentals support that outcome, but because $40 is the reference point, the number at which the loss disappears, and the decision starts to feel like it was right all along. Behavioral economists call this the disposition effect, the systematic tendency to hold losing investments far too long while selling winning ones far too early. Loss aversion applied not to a falling portfolio, but to the act of making a loss official. It is one of the most consistently documented patterns in retail investing. Pattern 3, avoidance. Then there's the person who never invests at all, $50,000, sitting in a current account or low-yield savings account. They understand compound interest. They've read about index fund returns. They know, intellectually, arithmetically, that keeping significant capital in a low-interest account while inflation quietly erodes its real purchasing power is a costly form of inaction, but they don't invest. Because investing means exposing that $50,000 to the visible, concrete possibility of loss. And the psychological pain of watching it drop to $42,000, even temporarily, even as a normal feature of a healthy long-term strategy, feels more immediate, more real than the slow, invisible erosion of inflation. Inflation doesn't appear as a red number on a dashboard. A portfolio correction does. And loss aversion responds to visible, immediate, concrete threats. Inflation is none of those things. So the brain chooses the threat it cannot see over the pain it can feel. Using historically typical long-term market return assumptions, that same $50,000 can grow substantially over a decade, far beyond what low-yield cash usually delivers. The cost of avoidance, the gap between what that capital is and what it could become, isn't abstract. It has a number, a large one, and it accumulates silently in the background of every year the decision to invest gets postponed. Here's why the brain works this way. For most of human history, loss wasn't a temporary condition recoverable in the next market cycle. Losing food sources, shelter, physical safety, these weren't setbacks. They were potentially fatal. The stakes weren't just high, they were existential. So the brain developed a threat detection system calibrated accordingly. Loss responses became faster, more intense, more urgent than gain responses. Better to overreact to a potential loss and be wrong than to underreact and not survive. That calibration was rational, adaptive, in that environment. The problem is, the environment changed. The brain did not. When your portfolio drops, your amygdala, the brain's threat detection center, reacts as if something genuinely threatening is happening. Those signals move fast, faster than rational thought, faster than your long-term plan can mount a defense. By the time your rational mind has assembled the case for staying invested, the emotional response has usually already made the decision. The logical justification you construct afterward, that isn't reasoning. It's your brain writing a convincing story around a choice it already made. This is why financial literacy alone doesn't fix it. You can understand market cycles. You can know in precise detail why selling during a correction is counterproductive. You can have a written investment plan sitting right in front of you and still feel, in that moment, that selling is the only reasonable thing to do. Because the knowledge lives in one part of your brain, the pain lives in another, and the pain moves first. Here's the uncomfortable part. The smarter you are, the better the story sounds. The reasoning feels tighter. The justification feels more airtight, more credible to yourself and to anyone you explain it to. But underneath all of it, same ancient threat response, running the same program it always has. Intelligence doesn't protect you from loss aversion. In some ways, it just makes the story harder to question. Research on long-term investor behavior found something worth examining, carefully. The people who consistently build wealth through full market cycles, through corrections, recessions, periods of sustained volatility, don't experience less loss aversion. The feeling is still there, the tightness, the pull toward cash, the urge toward action when the number moves in the wrong direction. What they tend to have instead is a pre-committed investment strategy, a written plan built during a period of emotional neutrality, specifically designed to be executed during a period of emotional intensity. The plan isn't there to override the feeling. It's there to make the decision before the feeling arrives. So when that Monday morning app check happens, when the portfolio is down, when the chest is tight, and the story about just temporarily moving to cash is starting to sound reasonable, the decision has already been made by a calmer version of themselves, in a moment when the amygdala wasn't running the math. The difference between investors who build wealth and those who consistently fall short usually isn't intelligence, it's structure. It's the presence of a framework that protects your long-term logic from your short-term emotions. Over a lifetime of investing, behavioral discipline matters more than market forecasting, every single time. Let me ask you something, directly. When did you last check your portfolio? If markets have been volatile, was it once a day? More? And did checking actually make you feel better, or did it just feed the anxiety while making it harder to look away? That's loss aversion in real time. Each check is a search for reassurance that the loss has stopped. Each red number is a small reactivation of the threat response. And that daily emotional exposure, compounded over weeks, quietly shapes decisions in ways most investors never connect back to the habit. Think about what you're currently holding. Is there a position you've been holding past the point of rational justification, just waiting to break even before you exit? That's the disposition effect, loss aversion keeping you anchored to a reference point the market has no obligation to return to. And think about the capital you haven't deployed yet. Saving sitting in a low-yield account while you wait for the right moment? Is that a strategy, or is it the quiet avoidance of a pain that hasn't happened yet? These aren't character assessments, they're patterns, named, documented, remarkably consistent across every level of investor sophistication and net worth. Naming them is the beginning of working with them, rather than living inside them. Here's what this actually means. Loss aversion is not a flaw. It's an adaptive feature of a brain built for an environment where losses were genuinely catastrophic. It kept your ancestors alive in conditions no market correction has ever come close to replicating. The problem isn't the wiring, it's the mismatch. The threat is a temporary percentage drop on a screen. The loss is unrealized, recoverable, and in the context of a long-term wealth-building strategy, often completely irrelevant to the final outcome. The investors who build real, lasting financial independence through full market cycles aren't the ones who eliminated loss aversion. That isn't possible. They're the ones who learn to recognize the feeling for exactly what it is, not a financial signal, a threat response. Once that distinction becomes clear, once the tightness in the chest can be accurately labeled as ancient biology, not current financial intelligence, a small but significant gap opens up between the feeling and the decision. And in that gap is where the long-term plan lives. Not because acting on it is painless, but because the plan was built by a calmer version of you, one that understood exactly what loss aversion was going to do in this exact moment and made the decision before it arrived. That gap, compounded over a retirement timeline, is worth more than any single market call you will ever make. So the next time a correction hits and that familiar tightness shows up, before you open the app again, before the story your brain is constructing gets any more persuasive, before just temporarily moving to cash starts sounding like wisdom, ask one question. Is this a financial signal, or is this loss aversion? Because they feel identical, same sensation, same urgency, but they lead to very different places. Your brain isn't broken, it's ancient. It's trying to protect you from a category of loss it wasn't designed to understand, one that is temporary, recoverable, and in the context of a long-term investment strategy, expected. Understanding that won't make the feeling stop, but it might make you wait one more day before you act on it. And in long-term investing, one more day is sometimes the difference between compounding and starting over. Loss aversion doesn't stay in the market. Once you can name it, really name it, in the moment it's happening, you start seeing it everywhere. In every financial decision where something feels like it's on the line. It doesn't really leave you, but that isn't a bad thing. If this changed the way you think about your investing behavior, the next video takes it further. Because loss aversion is one bias, but it doesn't operate alone. There are several other psychological patterns quietly compounding on top of it, patterns that influence nearly every financial decision you make. And here's the uncomfortable part. They tend to hit smart people the hardest. The next video is called Why Smart People Make Terrible Money Moves. It's an exploration of how analytical intelligence can sometimes become an unexpected obstacle to building long-term wealth. Subscribe so you're there when it drops. See you in the next one.